Get into the book reading, The Dhando Investor by Monish Pabrai. I have not read this book yet, but this is a good time to read it now. You know, I've been busy with my book business, and it's been tough for me to just sit down and get some reading time in. So every month, I've been reading on my live stream to just help people out. And so I'm just going to help out and read something. I'm excited for this. So, copyright 2007, and we're going to read chapter 5. And the Dhando Investor book, Monish, 330 English ordinal. So, you know, it's falling right in line, a book that people should be reading. I like his work. I like his thought process. I like his investing strategies. So I really recommend this person, and hopefully you like this reading as well. Chapter 5. All right. The Dhando framework. We're just going to read a couple pages from this. We'll read at the end. So I'll read a little bit, but I just want to give the Dhando framework in a summary first, right? So the first one: invest in existing businesses, invest in simple businesses, invest in distressed businesses and distressed industries, invest in businesses with durable moats, few bets, big bets, and infrequent bets, fixate on arbitrage, margin of safety always, invest in low risk, high uncertainty businesses, invest in the copycats rather than the innovators. So, you know, those are actually some key concepts that maybe as WAF on the other side that we talked about earlier, they might not agree with. But I think Monish has some very good, solid key points. All right. And we'll go through a couple of these. I like number 5. Bet heavily when the odds are overwhelmingly in your favor. Number 5 on the Dhando framework. Chance that Papa Patel's motel could have failed. However, on 2 serial bets made over 5 years, the odds that both outcomes go against Papa Patel are slight. Even when he loses both bets, since he did not have much to start with, his losses are pretty minimal. And he's talking about the Patel family that took over motels, this Indian family that became a motel powerhouse empire. His societal safety nets help him get back on his feet. But when he wins, and the odds are over 99% that he wins at least once, he gets over 20 times his money's back. It's classic. Heads, I win. Tails, I don't lose much. Warren Buffett's business partner and vice chairman of Berkshire Hathaway, Charlie Munger, uses horse racing's pari-mutuel betting system as one of his mental models when approaching investing in the stock market. Unlike a casino, in horse racing, you are betting against other bettors. The horse takes a flat 17% of the total amount of wager. Frictional costs relative to stock market are very high, according to Munger. To us, investing is the equivalent of going out and betting against the pari-mutuel system. We look for the horse with 1 chance in 2 of winning, which pays you 3 to 1. You're looking for a mispriced gamble. That's what investing is. And you have to know enough to know whether the gamble is mispriced. That's value investing. Now, I like that because that's what I believe investing should be all about. Finding those mispricing. It's all about finding those mispricings. To be a consistent winner at the racetrack, a person has to overcome the staggering 17% frictional cost of placing a bet. According to Munger, there are actually a few people who are able to make a living by betting at a racetrack after paying the full 17%. These folks watch all the horses and races, yet place no bets. Then, when they encounter widely misplaced odds in their favor on a horse about which they know a great deal, they bet heavily on that one horse in that one race. After that, they go back to watching the horses and races indefinitely with no bets placed. Another good opportunity shows up. It is not too different from all 5 of our Dhando entrepreneurs. They've all concentrated their capital in their bets. Most of the time, they either do nothing or place minuscule bets. Every once in a while, they encounter overwhelming odds in their favor. At such times, they act decisively and place a large bet. And so that's actually a good one. I'm glad I read that one. So again, Dhando framework, that was 5 on the framework. Bet heavily when the odds are overwhelmingly in your favor. And I have to look up more on that horse betting racing. That's actually kind of cool. I'll do one more. All right. I'll do 2 more. I'll do 7, 8, and 9. 7, 8, and 9. 7. 7. All right. Sorry about my camera today. I'm just going on. Buy businesses at big discounts to their underlying intrinsic value. It is unlikely that Papa Patel ever read The Intelligent Investor by Benjamin Graham, or even heard of Graham's margin of safety. Nonetheless, Papa Patel intrinsically understands the concept of minimizing downside risk before ever looking at upside potential. Let me read that again. That's actually pretty good. Papa Patel intrinsically understands the concept of minimizing downside risk before ever looking at upside potential. If you buy an asset at a steep discount to its underlying value, even if the future unfolds worse than expected, the odds of a permanent loss of capital are low. That's exactly what Papa Patel did. He had a huge margin of safety when he bought the motel. According to Benjamin Graham, the function of the margin of safety is, in essence, that of rendering a necessary and accurate estimate of the future. So that's good. Buy businesses at discounts to their underlying intrinsic value. Basis of value investing right there. Number 8, look for low risk, high uncertainty businesses. Papa Patel's motel purchase did not have much risk associated with it. However, the outcome had significant uncertainty associated with it. What if gas prices continued to stay high or the recession continued on? Even in that scenario, Papa Patel would still be the low-cost provider. He'd still be able to charge less and end up with higher occupancy. Even in the gloom and doom scenario, he comes out looking pretty good. If the economy booms and the gas prices moderate, he's making a killing. He has very low risk and relatively high uncertainty with the motel investment. Low risk and high uncertainty is a wonderful combination. It leads to severely depressed prices for businesses, especially in the pari-mutuel system-based stock market. Dhando entrepreneurs first focus on minimizing downside risk. Low-risk situations, by definition, have low downside. High uncertainty can be dealt with by conservatively handicapping the range of possible outcomes. You end up with the classic Dhando tagline, heads, I win, tails, I don't lose much. And number 9, the last one that we'll go over, it's better to be a copycat than an innovator. The first few Patels paved the way for the thousands that followed. Papa Patel had seen a few of the earlier Patels latch on to buying small motels. In conversation with these pioneers, the no-brainer business model became painfully clear to him. He did not set out to innovate. He simply followed the path laid out by his peers. The thousands of subsequent Patels who did not innovate either. The thousands of subsequent Patels who followed did not innovate either. Neither did Manal. I too got the seed of the idea from the trans tech from my previous employer, Tellabs. They weren't interested in pursuing it, and I saw tremendous potential. So I left Tellabs and lifted and scaled the idea. Innovation is a crapshoot, but lifting and scaling carries far lower risk and descent to create and decent to great rewards. Let me read that again. Innovation is a crapshoot, but lifting and scaling carries far lower risk, and decent to great rewards. And so that's the Dhando framework. And let me just summarize that again at the end. Invest in existing businesses, invest in simple businesses, invest in distressed businesses and distressed industries, invest in businesses with durable moats, few bets, big bets, infrequent bets, fixate on arbitrage, margin of safety always, invest in low risk, high uncertainty businesses, and invest in the copycats rather than the innovators. And so that's the Dhando framework. That's the Dhando investor. Hopefully you learned a little bit. All right. That was solid right there. So again, sorry for the screen. We just got to deal with it.